Good morning again to everyone, and welcome to the JRG webinar for May on What's Happening Benefit Updates. Again, as another brief reminder, after the webinar, we will send everyone who participates a copy of the PowerPoint, a copy of the recording of the webinar, and then a compilation in a Word document of any questions that you asked today. Again, as a reminder, if you do have any questions, you can go ahead and type them in the question box, and we'll address them after the end of the webinar. So the first thing we'd like to do is go ahead and thank all of those who are participating who come to us through one of our partnerships. We have them all listed here, and again, we value and appreciate your participation through our partners. So our agenda. Generally, towards the middle of the year, I believe it's always good to step back, gather our thoughts, or at least my thoughts, and see what's really been happening with the agencies and the departments as to regulations that have been issued and how it's affecting employee benefit plans. We've seen some activity in December. Basically, there was a lot of activity from the agencies, and actually we've even received some information from the IRS throughout the year so far. So we want to go ahead and make sure that you're aware of that and we address it. So our agenda today is going to really cover what's been happening. It's in the last 6 months or so. And again, these are issues of which you should be aware, and we'll talk about some takeaways at the end. So the first thing that we're going to go ahead and talk about is how some of these regulations that were issued affect the Affordable Care Act and any updates. First thing, we know that the Affordable Care Act, it includes what's considered a 40% excise tax on high-cost employer-sponsored health coverage. Now, this tax has become lovingly known as the Cadillac tax. And the Cadillac tax applies to the aggregate cost of an employer's employees' applicable coverage that exceeds a certain dollar limit, what we consider a tax threshold. Now, the dollar limits for 2018 were set as, for an individual, $10,200, or for family coverage, or not really family, anything other than single coverage, $27,500. So what that threshold means is that right now, if for an individual, for their employee health care coverage, if you as an employer and as an employee together, they're paying $11,000 a year for that coverage, you've exceeded the threshold, and you would be subject to the Cadillac tax on anything that exceeds $10,200. However, we have to have a word of caution here because, as we're going to see in a minute, the tax has been delayed from 2018 to 2020, and naturally that threshold will increase as it will increase in every subsequent year once the Cadillac tax becomes effective. So how do we know that this has been delayed? In our appropriations bill that President Obama signed in December of 2015, there was a provision in there, again, when we looked at all the different appropriations, and again, which delayed the Cadillac tax. We know that the members of Congress keep looking at this and saying, is it something viable? Should we get it out? Should we repeal it? And of course, as of this point, no action's been taken on it, so it still is a viable provision of the Affordable Care Act. So when we talk about the Cadillac tax, really, what are we talking about? So what does it include? Again, it includes the employers and employee contributions to health insurance premiums and contributions to any other tax-favored health account. So what we have to be thinking about is that if a benefit is made available to an employee, and again, it's always a health care benefit, and is excludable from that employee's gross income, then it's going to be subject to the Cadillac tax. So when we talk about tax-favored accounts, naturally, again, we talk about any premiums for a major medical coverage, but we also have to consider any health flexible spending account arrangement, accounts contributions. We have to look at health reimbursement arrangement contributions, and also any employer contributions to a health savings account. So our word of caution with HSAs is that if an employee by himself or herself puts money into an HSA and not through an employer cafeteria plan, or the employer does not give the employee money, then that would not be included in the Cadillac tax. It's only when an employer puts money into an HSA or the employee is able to contribute through a cafeteria plan that the HSA will be included. Also, when we talk about health care, the statute is a little bit wishy-washy on what kind of coverage has to be included, because it only talks about health care, and the statute specifically excludes fully insured dental and vision. However, by putting those words fully insured in the statute, we leave self-insured dental and vision out there, and right now the assumption is that any self-insured dental or vision program would also be subject to the Cadillac tax. Now, based on IRS requests for comments that we received last year, we know that they're considering and leveling the playing field. They want to say if you don't include fully insured dental and vision, you shouldn't include self-insured dental and vision. But we've yet to see that. Some other things that we have to be concerned about as to what would be included when we're looking at the Cadillac tax. Any kind of coverage for specified disease, illness, that's paid on a pre-tax basis, such as if you offer your employees the opportunity to get cancer coverage on a pre-tax basis. Any kind of hospital indemnity plan that's paid on a pre-tax basis. Also, we would look at wellness programs and also on-site clinics. So continuing with the Cadillac tax, we always want to know who has to pay for it. And again, the statute, and I apologize because I keep referencing the statute because as of right now, we don't have any rules or regulations on the Cadillac tax. And again, that is why the IRS continues to ask for comments, because they really would like to have our feedback to say, what kind of rules do we write for this statute? So right now we're told that the party responsible for paying is the entity providing the coverage. And to me that's an interesting term because the entity providing the coverage under a fully insured plan is pretty obvious. That's an insurer, it's the carrier. But when we get into a self-insured basis, again, it's a little bit murkier, a little bit gray, because who actually is the entity providing the coverage? Is it a third-party administrator? Is it a carrier through the administrative services company? Or is it the actual employer? So that's one of the terms that has to be decided from the regulators. Who really is that entity providing the coverage? So when we talk about this Cadillac tax, if a fully insured carrier would be responsible for it, we know what's going to happen with that. They're going to pass it right on down through the premiums. Based on requests for comments that the IRS put out last year, one of the things that they're considering, they say, if the carrier does pass this tax down to an employer, that it should be kind of like a separate line item, because you don't want to keep snowballing the premium. If you keep adding a tax to a premium, naturally the premium goes up, the tax will go up. So again, there could be a big snowball effect here, and they're trying to nip that in the bud. The other thing you also have to realize about the Cadillac tax is, first of all, you as the employer, whether you're self-insured or fully insured, you will have to determine and allocate who has to pay that tax. So let me give you an example. Let's say that you have two different healthcare products out there. You offer one product under Carrier A and one product under Carrier B. If you would be subject to the Cadillac tax, you would have to look at which employees are in product A from Carrier A, which are in Carrier B, and determine which carrier has to pay what portion of any type of the Cadillac tax that would be applicable. The other thing is, the Cadillac tax is going to be very subjective to each employee. Let's look for example. Remember I said that you would include any type of health care premiums, and you would also include any type of health flexible spending account arrangement that's put in as a contribution. So you have me as an employee. I have individual coverage, and so I go ahead and I have to pay, my coverage costs $8,000 a year. And I contribute $2,550 to the Health Flexible Spending account. Well, my amount is going to be more than the current $10,200. So you may have to go out and figure, what's the Cadillac tax for me? Then you have the next employee who also only has individual coverage, but no contributions to a Health Flexible Spending account. You have to see if that person would be subject to the Cadillac tax. So you see, it is very subjective. I talk about lots of confusing and conflicting rules based on the comments that the IRS put out there last year that they're asking about. It really is very confusing. I mean, they're talking about possibly, charging a different threshold for based on your demographics, based on your age, based on gender of your employees. So this Cadillac tax is far from settled, and I'm sure we're going to see a lot more information on it in the upcoming years. Again, as we noted, it's been delayed until January 1st, 2020, and the threshold right now estimated will go from $10,200 for an individual up to $10,800 at that point, and from $27,500 for other than single coverage to $29,100 for other than single coverage. The next thing we want to talk about, and again, it's based on the appropriations bill signed in December, and it's called the Health Insurer Tax. This is known as HIT. What this tax is, it is on medical, dental, and vision, and it's insured products. And an insurer is responsible for paying this tax. But again, as we know, when an insurer gets taxed, especially on something like this, it passes it down to the employer. The HIT is based on an insurer's percentage of premiums. It's actually prorated. And the best example I could give you is, let's say that across all of the United States, all of the healthcare premiums collected are $10 billion. And we have one carrier, just Carrier A, and Carrier A alone collects $1 billion of premiums for medical, dental, and vision. So since Carrier A collects $1 billion of a total $10 billion premiums, their tax is based on 10%. It's prorated because they have 10% of the premiums that are collected. So again, when I talk about it being passed down, it will depend on what carrier that you use for some of your benefits as to how much this tax can be. However, we have seen in the last 2 years that it generally runs about 3 to 4%, that it increases the cost of your medical, dental, and vision. What the appropriations bill did is it said, we are suspending the HIT for 2017. So again, continuing 2016, suspending for 2017, and it's going to be back in 2018. So it's not going away, it's only been suspended for 1 year. So basically what that means is, for 2017, you possibly could see a little bit of a decrease. Of course, based on your overall utilization, that would be determined. But because the HIT would not be included, there could be a slight reduction, but again, we go back up in 2018. The next issues that we're going to talk about come from IRS Notice 2015-87. And this notice was issued on December 15th December 15th of 2015. I thought the notice was interesting because it had a lot of information in it that employers need to be aware of. Some of the things it talks about will affect affordability of coverage for those of you who may be an applicable large employer. It talks about flex credits, cash opt-outs. So again, a lot of interesting information. And the first issue under IRS Notice 2015-87 we want to discuss is how it affects affordability for those of you who are ALEs. A brief review. Remember that as an ALE, an applicable large employer, you're one who has 50 or more full-time equivalents employees in the preceding calendar year. If you are an ALE, you have to offer minimum essential coverage, MEC, to at least 95% of your full-time employees and dependents. If you don't offer that coverage, a full-time employee goes to the exchange and gets a subsidy. You could be penalized for every full-time employee at $2,160 times every full-time employee. If you do offer MEC coverage, but that coverage is not minimum value, and that minimum value is not affordable, then if you have one full-time employee goes to the exchange and gets a subsidy, you could be penalized at $3,240, but only for the full-time employee who gets that subsidy. When we talk about coverage being affordable, what we look at is the employee-only cost for your lowest option available. So again, as an example, you offer two different options. Maybe your PPO costs the employee $100 per month, and you still have an HMO that only costs $50 per month. The HMO would be the lowest cost option, so that's what you would base affordability on. And to be affordable means it cannot exceed 9.66% of the employee's income. We have some what's called safe harbors when you're looking at affordability, and it says that you can use an employee's W-2 wages, their rate of pay, or you can use the federal poverty level. In the last couple of months, as employers were doing their 1095-C reporting and then their 1094-C, there were some questions about this, the safe harbor and affordability. Some employers were coming up with some different ways of saying, well, this is how we decided it was affordable for an employee. The rules don't say that you can't use another way if you deem it's the best way to consider or determine affordability. You just have to be consistent. But then what happens is you do not meet the safe harbor requirements. So you need to be cautious of that. We know penalties only triggered if a full-time employee receives a subsidy. And as a reminder, who's a full-time employee? One who has on average 30 hours a week or 130 hours a month. So now when we're talking about affordability, let's look at some issues that can be affected. And the first thing is that if you as an employer, if you're offering a health reimbursement arrangement, we weren't real clear how if an employer did offer an HRA, how that affected an employee's affordability. And what the notice from 2015 told us, it said that if an amount is available under an HRA that an employee may use to pay premiums for an eligible employer-sponsored plan, then that HRA contribution is counted toward the employee's contribution when determining affordability. And I have an example on the next page, and that will help make it clear what I just stated. You have to meet these conditions in order for HRA contributions to be put towards the affordability. The amounts have to be made available within a reasonable time before the employee enrolls. Made available means the employee has to know what kind of amount of dollars that we're talking about. So of course, the money doesn't have to be available before they enroll, but we have to know how much money are we considering. Also, the amounts can only apply to the immediate subsequent period. So it can only be applicable to the following plan year. It can't be carried over. The employer contribution is treated as prorated monthly. Now we know that HRAs can only be, there can only be employer contributions. There cannot be employee contributions. And when we look to see affordability, again, we say that it's prorated monthly. So if you as an employer give an employee $1,200 prorated monthly, that would be considered $100 a month. And finally, this HRA, it has to be integrated with major medical coverage that you offer the employee. So let's look at the example of what we just talked about with this HRA arrangement. So the employee contribution for an individual health coverage is basically $200 a month. For the year, you as an employer, you make newly available eligible employees $1,200 under an HRA that the employee can use to pay the employee share major medical coverage, cost sharing, or pay towards the cost of vision or dental coverage. So since they can go ahead and use this to pay towards the cost of that coverage, this is going to affect their affordability, and it will lower an employee's affordability threshold. Because what we do is we take the $1,200 that the employer is providing, we prorate that, which would be $100 a month, and we deduct that from what the employee's premium contribution is required for health care coverage. So we said the employee's health plan is $200 a month. The employer gives them $100 through the HRA. So for affordability issues, this employee has to contribute $100 a month, and that's how we for determining affordability. The next spending account that we want to look at and to see how it affects affordability of coverage are Section 125 or cafeteria plans. And the first thing we're looking at are considered flex credits. A flex credit is basically $1 that an employer will go ahead and give to an employee to spend under the cafeteria plan for any qualified benefits. The employer may say, I'll give you $400 a month. You can use it to pay for your health care, your dental, your vision. So under this notice from 2015, what we were told is that the flex credit, it will qualify as a health flex contribution, and it would count towards the employee contribution when determining affordability. For it to be a health flex contribution, the employee may not opt to receive the amount as a taxable benefit, which means cash. The employee may use the amount to pay for minimum essential coverage, which means health care coverage, or they can use it to pay for medical care, qualified medical expenses under Section 213. So basically what we said is that if you as the employer provide the employee with flex credits and they can use it to pay for medical care, then that's a health flex contribution. Any contribution that the employer would make would go ahead and affect or lower the employee's affordability amount. And we have an example of this in a minute that we can talk about. However, on the next slide, we talked about a health flex contribution, and if it's not a health flex contribution, we're told logically it's a non-health flex contribution. A non-health flex contribution is a flex credit that can be used towards medical coverage, health care, dental, vision, but also may be used to purchase disability coverage or some type of life insurance. If the flex credit that you provide to your employee is a non-flex credit, then it does not count towards affordability under the Affordable Care Act, and that's to use it to being an applicable large employer. So as to this flex credit and for the non-health flex credit contribution, it's not applicable until 2017 if you meet certain transition relief that was provided. So as long as you've had your non-health flex credit plan in place before December 16th of 2015, you're good until your 2017 plan year. Also, there could be no substantial increases in that flex contribution. So on the next slide, we have an example of what we just talked about. So here we have an employer that offers employee coverage under a group health plan, and they provide it through a Section 125 cafeteria plan. If an employee elects self-only coverage, he's required to contribute $200 per month toward the cost of the coverage. And you as an employer, you offer the employee flex credits of $600 for the entire plan year. Now, just like with the HRA, we have to prorate any employer contribution. $600 divided by 12 would be $50 a month. So under this flex credit, they can only use it again to pay for MEC coverage or to pay for co-sharing. They cannot use it to go ahead and get disability or life insurance. And since they can't use it for other non-medical benefits, This is a health flex contribution. So when determining the affordability of the employee's coverage, we get to use this amount and reduce the employee's contribution to their health plan. We said it was $200. We get to take off the employer's $50. So now we look at affordability based on $150 a month. Again, I have a note here that, remember, this is only for health flex contributions. If it's non-health, then it doesn't count towards affordability. The next issue that was addressed by the IRS and actually all departments in 2015, we talk about cash in lieu or opt-out incentives. Now, the first thing that I want you to be aware of is that a cash opt-out is not the same as a flex credit. A flex credit is what the employer gives to an employee and says, here, go ahead and buy your benefits. An opt-out or opt-out incentive is when an employer says, if you waive my coverage under our group health plan, I'll give you X amount of dollars a month. I'll give you 100 or 150. As our example indicates, an employee can elect employer-sponsored medical coverage, or if they waive that coverage, they can get $100 in cash wages. That's the basis of the cash opt-out. What we've been told by the departments based on the IRS, but based on the notice, is that starting with 2017 plan years, an employer cannot pay opt-out incentives without treating the amount as a required employee contribution. So now what we're saying is, if an employee has the option to receive cash because they waive an employer's health care coverage, when we look to see if the coverage that an ALE offered employee is affordable, we will take this cash opt-out into consideration. And how we take it into consideration is, again, we look at the employee cost for premiums plus the opt-out that would be available, and together those cannot exceed the affordability percentage. Now, what we've been told is the IRS says they're still pretty vague on this issue, so hopefully they're going to give us more rules and regulations on this. One thing that the IRS did address in their notice, it talks about conditional and unconditional opt-outs. Again, anything to make it more confusing for us. A conditional cash opt-out is when you as an employer say, okay, Mr. or Miss Employee, you can go ahead and waive out of our group health plan, but only if you have other health care coverage. So you're covered under your spouse's, or you may work for another employer where you get coverage. So that's conditional. An unconditional cash opt-out is when you say, okay, Mr. or Miss Employee, you don't want our coverage? Then don't take our coverage. I'll give you $100 a month, and you're not required to have other coverage. So again, what the IRS is doing is saying, if the cash opt-out is conditional, meaning you have to have other coverage, then that cash opt-out would look favorably on affordability. It would lessen it. If it is unconditional, it would not look favorably on affordability. It would not change it. And as a matter of fact, it may increase it. So again, we're looking at 2017, so we're still a little bit a way off. And the IRS will definitely be giving us additional information on this. The next thing to notice from 2015 addressed, and again, this relates to the Affordable Care Act, is the hours of service calculation. We know that under the ACA, a full-time employee, as we've already noted, is one who performs, on average, 30 or more hours of service per week, or 130 hours per month. So we don't really say the employee works this. We now say the employee performs hours of service. And an hour of service includes any hours that they worked. So each hour for which the employee is paid or entitled to be paid for the performance of duties. And also when we're looking at these hours of service, we have to take into consideration any paid time off. So any time that the employee is paid for non-performance of work, such as vacation, a holiday, a sickness or incapacity. We know that when we received regulations and talked about hours of service, that there are special rules for unpaid leave, such as family medical leave, Uniform Service Employment and Reemployment Rights Act, and jury duty. And a lot of these questions were addressed in this 2015 notice. So now when we're looking at these hours of service calculation, we talked about disability. We actually are supposed to include disability when we're counting if the hour of service is worked. And this is only if the employee is paid while on disability. And as far as the IRS is concerned, they don't care if it's long-term disability or short-term, as long as it's disability. There's no difference. There's no limitation of the hours that are considered when we're looking at the calculation and what we have to include. There's no 501-hour cap like we have with the 401k plan when we look to see if someone has performed their required hours of service. I want to go ahead and note there is an exception for this 501-hour cap for educational organizations. I'm not sure if we have any on the call today. No difference whether you're self-insured or fully insured. What we have to be careful with is this coverage that's paid with pre-tax or post-tax wages. If coverage is paid with after-tax wages, then the resulting payments do not result in an hour of service. And our example is a voluntary disability program. So what do I mean? So I'm working for you, and unfortunately, I have to go out on disability. And you have a disability program that you provide to me, and you say, I'm going to receive 2/3 of my wages, and you go ahead and you pay for this insurance to cover it. Since that is an employer-provided program, you would count my hours while I'm on disability as to whether I'm a full-time employee and would be eligible for health care coverage. However, on the other hand, you don't have a disability program, but I have bought voluntary disability coverage, and I'm paying for it on a post-tax basis. Well, since I'm paying for that plan myself, you have nothing to do with it as the employer. You would not count those hours towards my hours of service and whether I'm eligible for health care coverage. Likewise, if it's a voluntary program and the employee is permitted to pay for disability on a pre-tax basis, that's considered employer provided, and it is counted. What the IRS notice clarified in 2015, we weren't sure, because when we talk about disability or incapacity, one thing we always took into consideration was workers' compensation. If someone's out on workers' comp, then they're incapacitated. And it was the assumption that we would have to count those hours. However, what we've been told is that if someone is out disability and it's due to workers' comp, then you do not count that as an hour of service. You also don't count any time for unemployment or state-mandated disabilities. So hopefully, if you're an ALE and you're counting hours of service for your employees, that those clarifications are going to help you out. Next thing we want to talk about, again, are health reimbursement arrangements. Our brief background, we know that in 2013, the IRS informed us that an HRA must comply with the Affordable Care Act reform mandates. The specific mandates they had to comply with is that they have to offer coverage, preventive services at 100%, and that there can be no lifetime or annual limits. What happened in 2013 is that basically standalone HRAs were done away with, because again, a standalone HRA can't comply with the ACA. So what the IRS did tell us, they said that in order for an HRA to comply with the ACA, it must be integrated with another group health plan that satisfies the ACA requirement. So again, some other major medical program. And it was in this same 2013 notice that we received that the IRS provided that an HRA could not be integrated with an individual program or policy. So in 2015, we get this notice, 2015-87. The IRS wants to give us additional clarifications as to how HRAs can work. And what they told us in this most recent notice is that HRA reimbursements, again, must be integrated with the group health plan, but also an HRA cannot extend to an employee's spouse or dependent unless that spouse or dependent is also enrolled in the employer's qualified plan. So what does that mean? You're currently offering an HRA to your employee. Employee has individual coverage. Your HRA says, if your spouse or dependent has any co-pays or deductibles, you can use that out of our HRA. Previously, we thought that was okay, but based on the guidance that the IRS has given us, they're now saying that in order for any reimbursements to be made from that HRA, they can only be made for individuals who are covered by the group health plan. So you want to go ahead and be careful of that and watch for that. You have some transition relief. This requirement, as long as the HRA was set in place and the terms were adopted prior to December 15, 2015, you won't be in violation until the first day of your plan year beginning on or after January 1st, 2017. So again, you have some time to look at your plan and determine whether it's compliant or not. Another HRA issue, and this didn't come from the HRA notice, but it came from an IRS Chief Counsel advisory letter. And it says that an HRA can be used to reimburse an employee on a tax-free basis for premiums paid by the employee's spouse, but only if the spouse paid those premiums on an after-tax basis. This letter or notice by the IRS came out in October. I actually just came across it probably about a month or so ago, and when I read it, I found it very surprising. It seems like it's another way that the regulatory agencies are chipping away at our spending accounts, making them less valuable to our employees. So again, I want to make you aware of that, and if you are currently paying for a spouse's premium through your HRA, you may want to go ahead and look at this letter. And then finally, we just want to go ahead and briefly talk about discrimination rules for an insured plan. If a plan is self-insured, the current non-discrimination rule says that an employer cannot discriminate as to eligibility and benefits in favor of highly compensated employees. Under the Affordable Care Act, insured plans will have to meet that same requirement. Right now, this non-discrimination requirement is what's called a period of non-enforcement. They haven't provided us any rules as to how we can follow this and do this, so again, they can't enforce it against an employer. What we're talking about here is, right now, you as an employer, you may say, for all of our executives and management, we pay 100%, but for staff, we only pay 50% of the health care premium. Based on the ACA non-discrimination, that would be discriminatory, and your plan would be in violation. So again, it's still okay if you are currently have that practice, but once the non-discrimination rules for fully insured plans come out, that's no longer going to be accepted. As I've noted, no rules still pending, and what the IRS has so nicely told us, don't hold your breath on these rules because that's the caboose on the regulatory train. In other words, they keep pushing it to the back of the train before addressing it. Some things they're considering, whether, again, whether discrimination is going to be based on actual participation instead of eligibility, and they might look at some type of safe harbor. So our next area that we want to look at are Exchange Notice Program, HSAs, and SBCs. If one of your employees is receiving a subsidized coverage on the exchange, you probably would like to know that. I mean, just for general purposes. When we talk about whether an employee is getting coverage and we talk about these notices, there's two ways an employer could be notified that an employee has received a subsidy. First, it's by the federally facilitated or state-based exchange. This program is not fully operational yet. It's only partially operating right now. Or you could be notified by the IRS. And you'd be concerned if you're notified by the IRS because that's probably because you're an ALE and you may be penalized. Now, in 2016, under this notice program, the federal exchanges will start to send notices in advance of premium tax credits to some employees, and they're going to send the notice to the employers. Basically, you'll say, your employee, we were informed that so-and-so is your employee. We want you to be aware that this employee has informed us that the coverage that you offer is not minimum value, it's not affordable, and thus they are eligible for a subsidy. If you receive such a notice, you have a right as an employer, whether you're a large employer or a small employer, to go ahead and appeal that notice. Because one thing, your coverage may be minimum value and it may be affordable, and this individual isn't eligible for that subsidy. Why these advance notices are nice? Well, first of all, it could help the employee out, because if the employee is not eligible for a subsidy and they're getting one, it could be stopped, because if they receive a subsidy and the IRS, based on their tax return, says you're not eligible, they're going to have to pay that money back. So again, it would be a way to nip it in the bud if they're not eligible for a subsidy. Why it's nice for an employer? You know what's going on with your employees, whether they're getting those subsidies or not. And first of all, this program, it's supposed to be starting, it said spring, which would be now the spring, so we're probably looking at summer, that employers would start receiving notices. Not all employers are going to be receiving the notice, and so don't be concerned if you don't get one. Talk among some of the attorneys that I've been reading things and I've been hearing things, is that they're a little bit concerned that if an employer gets this notice, whether they should respond to it or not. Because the attorneys are concerned that if an employer responds or appeals a notice that someone's receiving a subsidy, and then an adverse employment action is taken against that employee, that employee may have a discrimination charge against the employer. And what some attorneys are recommending, that you may want to have a third party review any exchange notices that you receive, and they go ahead and respond back to the exchange. Again, trying to add a layer of protection to the employer to say, you don't want to be concerned that you might have a discrimination charge because an employment action was taken when you knew an employee got a subsidy. Going to the next slide, if you don't get an exchange notice information on subsidy, you may be informed by the IRS. So after all the 1095-Cs have been put together and sent out to the employees, and you've done your 1094-C filing, again, this is if you're an applicable large employer, the IRS will be ready to look at all your information and determine whether you're subject to a penalty or not. The IRS is saying it's giving its assurance that employers will receive certification if one or more employees did receive a subsidy, and they'll contact the employer to inform them of any potential liability, and at that time you will have a chance to go ahead and respond to that. The notice that you receive from the IRS will advise you how the payment has to be made. You're not going to be required to include that in any of your tax returns that you're filed. And again, since they haven't started sending any of these out yet, this is only the preliminary information they've provided, and that's what we're relying upon. Briefly, we have a couple more minutes, and we want to go ahead and talk about health savings accounts. We know that the IRS announced the limitations on HSAs and HDPs for 2017. As a reminder, a health savings account, it's a tax-favored IRA-type trust or custodial trust. that can be contributed to by an eligible individual. The individual, they save taxes on it because HSA contributions are, again, tax favored. You can use HSA amounts to go ahead and pay for qualified medical expenses for the person who established the HSA, the spouse, or a dependent of the person who establishes an HSA. To be eligible to go ahead and either establish or have contributions made to an HSA, you have to be participating in a qualified high deductible health plan as of the first day of the month that you want a contribution made. I have a notice here that you need to watch because this is something that a lot of employees run into problems with. An employer says, we're having a high deductible health plan. You can contribute to an HSA, and the employee says, great. And then we find out that this employee is able to have qualified medical expenses reimbursed through another through the spouse's health flexible spending account. Health flexible spending accounts and health reimbursement arrangements are group health plans. They are not qualified high deductible health plans. So if one of your employees who wants to contribute to an HSA can be reimbursed through someone else's HRA or health FSA, then they are ineligible for an HSA. There are two groups of people who are ineligible to establish HSAs. And the first group is anyone who can be claimed as a tax dependent. And the second group is anyone who is entitled to Medicare. Now, we have to be careful because we have to look to say, what does it mean entitled to Medicare? Does that mean that they're just eligible? They've turned 65 and now they can sign up for Part A? No, entitled to Medicare in this instance means that they're actually enrolled and they're receiving Medicare benefits. So merely being eligible for Medicare does not make an individual ineligible to establish or contribute to an HSA. We note that HSAs, the contributions are determined on a monthly basis. However, we do know that there is the possibility of making a full year's contribution if you meet certain requirements. So the next slide, again, we have the 2017 inflation-adjusted amounts. They were provided by the IRS several weeks ago. The annual contribution limitations, $3,400 for an individual, $6,750 for family. For a high deductible health plan, for self-only coverage, the deductible must be at least $1,300, family coverage $2,600, and out-of-pocket maximums $6,550 and $13,100 respectively for self-only and family coverage. So again, as you start your 2017 planning, if you do HSAs, you want to be aware of these limitation amounts. And then the final issue we're going to talk about are summary of benefits and coverage. Now we know that a plan must provide an SBC to participants and beneficiaries. And the purpose of the SBC is to go ahead and help participants make more informed choices among health plans and also help them to understand their coverage better. These have been in effect since 2012, and in 2013 we received a template, and since 2013 we have been using that template for our SBCs. However, this past April, actually April 6th, all of the departments, Department of Treasury, Department of Labor, and the Department of Health and Human Services jointly released the final template and final changes to the SBC. Now, compliance with the use of this new template will vary. If you are a calendar plan year, you have to comply as the first day of open enrollment beginning on or after April 1st, 2017. If you're a non-calendar year plan, then you have to start using the new form as of the first day of your plan year beginning on or after April 1st, 2017. Now, I keep saying you have to go ahead and use this. We know that if you're fully insured, that the carrier will provide the SBC to you and then you provide it to your plan participants. However, if you're self-insured, the employer, as the plan sponsor, is responsible for providing the SBC. I want to go ahead and briefly just talk about some of the changes that have been incorporated into the new template. There's a new explanation added at the top of the page, and it describes the purpose of the SBC, and it also gives you a link to where a participant can receive additional information regarding the SBC. In the important questions, the template now includes discussions on an individual and family deductible and what it means to have an embedded deductible. And also, very importantly, they changed the term person to now individual. In common medical events, they have some issues addressing preventive care, link to the formulary drug list that has to be included in the SBC, and then revised description on pregnancy care as to whether it's an office visit, whether it's prenatal or post-pregnancy. Finally, the required disclosure language that a plan offers minimum essential coverage and whether it's minimum value must now be on the SBC. That requirement has been in place since 2014, and an employer, if that notice isn't on the SBC, an employer is required to provide separate notice. Also, you have to tell anyone who, if they need access to a different language for the SBC, that they can go ahead and get that access. And then finally, they're giving us new examples. Previously, they gave us examples about having a baby, type 2 diabetes, and now they've included an example of a simple fracture. So some takeaways before we get to your question. Review any of your spending accounts that you have offered. If you're an applicable large employer, you need to know when any spending account program will affect the affordability of an employee's coverage. You really need to look at that carefully. HRAs, remember, spouse and dependent must be covered under the group health plan to be reimbursed by the HRA. Decide if you're going to respond to that exchange notice that you may receive, or whether you're going to solicit an attorney or a third-party vendor to do that. The HIT, we talked about, it may bring your premiums down a little bit in 2017, but 2018 they come back on, so they'll probably go up again. And then we just talked about the revised SBCs. They'll be in effect as of April 1st, 2017. Again, if you're fully insured, you're not responsible for creating that SBC, but it's always just a good, it's a good business practice to know what's included. So with that, we'll go ahead and see if you have any questions on today's presentation.
The first question, if a plan renews on July 1st, 2016, do the 2017 cash in lieu opt-out provisions apply?
Okay, so the question, the cash in lieu of the opt-out, it's going to depend, is it conditional or unconditional? If it is conditional, I believe it's going to apply to your July 1st, 2017 plan year. If it's unconditional and it was not in place before December 15th, it would apply to your 2016 plan year. So again, a little bit more information is needed for that.
The next question, if an employee makes $1,200 per month, does that mean that the cash opt-out and single premium, when added together, cannot exceed 9.66% of $1,200?
I'm going to ask you to read that question for me again.
If an employee makes $1,200 per month, does that mean that the cash opt-out and single premium, when added together, cannot exceed 9.66% of $1,200?
If that's your income, and if you're using rate of pay, and let's say that person is a salaried person, and they make the $1,200, then that's correct. For the cost, in order for it to be affordable, it cannot exceed 9.66 of that $1,200 a month. And again, that's based on the using rate of pay and a salaried information.
Oh, I'm sorry. There's an additional question that says this is a correction to the last question. cash opt-out and employees' contribution to single premium cannot exceed 9.66% of $1,200.
And again, when we're looking at affordability, if it is a conditional cash opt-out, which means that they have to show other coverage, then we count that money towards the affordability. And when we look at the employee-only cost, it would be reduced by that amount of money. And again, it can't exceed 9.66% of that salaried $1,200 amount. And again, when I answer these questions to you in the Word, I'll be looking up the regulations and probably go ahead and reference those to you, because as I indicated, some of those we need additional guidance that the IRS is going to be providing. Some of them have different applicability dates based on whether you offered it previous to December 15th or whether you start offering it after December 15th.
Okay. That's the end of the questions, Frances.
Okay. At this time, we'll give you another minute or so to see if there's any other questions. Okay, I don't see anything coming in as of right now, so we'll just go ahead before we end, give you a brief reminder that our next webinar is on Thursday, June 9th, 10 a.m. And we're going to be talking about these exchange subsidies, report filings, now what do we have to do. So this is going to be talking about possibly any type of audits that the IRS may have based on affordability. So with that being said, I want to go ahead and thank you for participating today. Hope you found the information helpful, and you'll receive additional information from us in a few days via email. Thank you. Have a good one.